Hello, and welcome to the very first episode of our new monthly podcast, Market Matters. Each month, we'll be bringing you big picture insights from leading investment specialists, exploring the opportunities, challenges, and potential threats shaping investors' portfolios now and into the future. We have an exciting lineup of experts planned for the months ahead, covering everything from global equities to more specialist sectors such as Japan and renewable energy. Our first guest is Charlotte Cuthbertson, manager at the MIGO Opportunities Trust, which specialises in discount opportunities in the investment trust sector. Charlotte has extensive experience in the asset management industry with a particular specialism in investment trusts. Starting with that topic, Charlotte, could you talk us through your background to becoming a fund manager and any challenges you have faced along the way?
Thank you so much for having me on today. So, my background was quite unusual, I suppose, coming into fund management. Investment wasn't something I particularly considered as a career. I didn't know anyone who worked in investment. It wasn't something that I'd thought of for myself as a career. And I finished university, I did a history degree and had that sort of traditional feeling a little bit lost and not really sure what to do with my life and what to do next. So I moved down to London and, to pay the rent, I took a maternity cover contract looking after the investment team, Miton Asset Management. And I just fell in love with investment. I fell in love with the job and what they were doing. I just found it so interesting. And I thought it probably played to my skill set in terms of research, in terms of the decision making. And the team at Miton were incredibly supportive. And they put me through my exams and they were very patient and very generous with their time and taught me everything that they knew or lots of what they knew, and it kind of went from there. So then I got promoted to environmental, social and governance analyst about a year after joining, and then about a year after that my co-manager Nick Greenwood was looking for a person to work on his fund and he asked me to join him. I absolutely grabbed that opportunity with both hands, and the rest is history. We've been working together for about 7 years now. So it was, a bit accidental, but I think that it's all worked out really, really well because I couldn't really imagine doing anything else at this point.
That's really interesting, thank you. So I'd like to start off by looking at discount opportunities in the investment trust sphere. What techniques do you use to understand why a discount might exist?
So that's an interesting question in terms of where investment trusts are at the moment and the background we see in the sector at the moment versus where investment trusts have been for the majority of my career. So I think when I'm looking back at sort of 2017, 18, 19, and into the early 2020s, investment trusts tended to be on wide discounts because the sector was out of favor, because they'd had a poor run of performance, because there was a manager change that maybe the market hadn't picked up. There was often reasons why investment trusts were trading at wider discounts or they were too small, etc. But if we look at where the investment trust market is now, there are far more investment trusts trading at discounts than there have been historically. First of all, you've had rising interest rates. So that means the trusts that were launched with the 10 years after the global financial crisis, when interest rates were very, very low and investors were starved for income, those trusts have struggled because investors have gone back to more traditional sources of income. So I'm thinking of trusts in the infrastructure section, the renewables, those kind of trusts, leasing, those trusts that were fund proxies and yield plays. Because investors have gone back to gilts, have really struggled. And we've had the issues with ongoing charges, which has been very tricky for sectors such as private equity. So in terms of what's going on at the moment, and this has been the widest discounts we've seen in a very long time. So it's a very different market to the one that I started my career in. But it's been tough for investment trusts, definitely over the past 18 months, 2 years. But it has given myself and Nick the opportunity to create a portfolio of what we think are really interesting ideas, discounts that we haven't seen for a very long time.
So, following on from that, how do you mitigate the risk, perhaps, that you see value in a discount, but the discount doesn't narrow over time?
So we're always looking for a catalyst. It's a huge part of our investment process because, as you say, there's trusts that trade on wide discounts that will continue to do so for the next year, 3 years, 5 years. So we're always looking for there to be a catalyst where we can extract that value, whether that's perhaps a wind up, a takeout. We think that the underlying portfolio will come back into fashion, or we think that the trust is doing different things in terms of marketing, and that should come through to fruition. So we're always looking for a reason that we think that discount will narrow. It's not sufficient just to buy wide discounts, because then you can end up in a difficult value trap situation.
Absolutely. And how active are you in lobbying boards about discount control mechanisms, for example?
Activism is certainly a tool in the box, and it's something that we've tended to do more behind closed doors in the past. I think where we are in terms of the market this time, we've become a bit more activist, and I think MIGO's move to asset value investors has been a big boon for that, because they're obviously very famous for being very activist investors. So that's something that we can leverage off our colleagues at AVI. And we do get involved, and I think it's been reassuring to see how many boards in this cycle are doing things and looking at various ways of closing that discount or returning capital to shareholders.
So, do you think diversification matters for investors that are looking to make money from discount opportunities in investment trusts? For example, should investors avoid having a number of holdings or bets in the same sector?
Diversification is something that we do build into the MIGO portfolio, in terms of often you have various things working for you at different times of the cycle and at different opportunities. Because obviously, when you're looking for catalysts, they don't all come through at the same time, or some can, some can't. And I think diversification is important. But if you look at something like property at the moment, there's a plethora of opportunities, and investors have done well if they'd had a decent slug in quite a few of those property trusts that have either merged or gone into wind down or been taken over. I think you naturally, in terms of where we are in the cycle, will end up with more trusts in certain sectors, especially with higher interest rates. You will just naturally end up with a bigger portion of your portfolio exposed to that area. But I think it is important to build diversification in, because there are just so many opportunities as well. And you want to be finding the best opportunities in all the various sectors.
Great, thank you. So, moving on to asset allocation, what tactical allocation changes have you made recently?
I wouldn't say that we have a sort of tactical allocation. We're not prescriptive about how much needs to be in any sector at any given time. We're just looking for the best opportunities. I mean, I probably sound a bit like a broken record at this point, but because of higher interest rates, we have got a lot of areas that have struggled because of that. So we have far more in the alternative income sectors. So that's renewables, infrastructure, leasing. We also have a portion of the portfolio in biotech. That's quite interest rate sensitive, and biotech companies have been trading at historically low valuations in comparison to the mainstream US market. We have a good portion in private equity, both that sort of more traditional private equity like OP Capital, and also we've built a basket of early stage growth trusts, so things like Schahalian, Augmentum Fintech, Seraphim Space, and Chrysalis. Again, these trusts have struggled because the cycle has changed, and there was a perception that their underlying companies would struggle in the new environment, that they were very cash hungry and very early on in their life cycle. But actually, the reality is that these companies are more mature than the market is giving them credit for. And we haven't seen the write downs that the market was fearing. So we've definitely moved the portfolio to be taking advantage of these areas, but we don't really allocate too tactically in terms of how we look at the portfolio.
Fantastic, thank you. Looking at your single country holdings, for example, in Vietnam and India, how do you manage geopolitical risk?
Geopolitical risk is definitely on the rise. I think that it's difficult to escape that, whatever you're invested in. It's definitely something that we did some work on earlier in the year, because we do have exposure in Vietnam, Georgia, and India. But I think that geopolitical risk has risen across the board. I think it's difficult to avoid it in its entirety. And we look at how the country is evolving, how is the economy doing, how stable is it politically, and we make a decision from that. So it's something that we're very cognizant of, but it's also, I think, inescapable in terms of investing at all at the moment. I think that Vietnam, Georgia, and India are reasonably politically stable, but it is something that we do keep a close eye on.
So, changing the topic and perhaps a slightly left field question for you, what surprised you the most about the stock market this year?
Great question. I think if we look at what we were talking about sort of end of last year and early this year, we had maybe anticipated and perhaps hoped that we would see interest rates coming down quicker, but inflation has certainly been stickier than anticipated. I think we were anticipating that the market would become a bit broader. We've definitely seen people moving into the Magnificent Seven rather than, seeing more of a broad movement in market. We've just talked about geopolitical risk. It's actually been interesting that markets have remained reasonably upbeat despite that backdrop, but none of us have a crystal ball, so it's very difficult to be too expectant when you're starting a year about how it's going to pan out. So you've just got to try and position yourself in order to get the best returns for your shareholders.
So, you mentioned the Magnificent Seven, which we've mentioned a lot on our podcast this year. And as we both know, they've dominated returns over the last couple of years. Are you worried about the narrow stock market leadership given their dominance? And second question on top of that, do you think the tech boom might start to run out of steam in coming months?
I think that there are companies in there that have decent growth and should perform and continue to do well going forward. I appreciate that sounds a bit like a politician's answer, but I think the valuations are pretty lofty. So you're pricing pretty much for perfection. So we could see, especially something like Nvidia, should there be a setback, that could be quite nasty. In terms of that sort of AI boom, I think that we overestimate how much that's going to change the world and be a huge thing over 2 years, and probably underestimate it over 10 years. So I think markets probably have got a bit excited around tech, and it would be nice to see investors looking elsewhere, but I can understand the fear of missing out and the difficulties of performing. If those areas are in your benchmark, it's very, very difficult to outperform without holding some of them. Thankfully, because we invest in the overlooked and unloved, the Magnificent Seven could not be further away from our investment mandate. So it's just not the game that we have to play, which is helpful. But it has meant that investors are just not looking at other opportunities. But that also means that lots of these areas are therefore very cheap for those of us getting in at this point. So that rally could continue for another year, but these valuations are pretty lofty. So when it turns, that could be quite nasty.
Thank you. What do you see as some of the key drivers of stock market performance over the upcoming months?
I think we have a lot of political risk coming if we look at the UK. And well, for our portfolio, we have Georgia as well, and we have the US election. So if we look at the UK in
Yes.
terms of how is that stock market going to perform going into the end of the year, the budget at the end of this month is hugely important. So we have the elections in Georgia on the 26th of October. Again, that will be quite important for that holding for us. And then you've got the US election, which is just hugely important for markets. And we could see some volatility both coming in and now coming out of that result. So I think that's probably over the shorter term what may drive markets. And then I think otherwise it will just be a continuation of what we've seen over the past year. It's inflation coming in versus consensus, it's interest rate cuts and how quickly do they come through, if at all. We've seen a cut from both the Fed and the BOE. Are we going to see more of that? Are we going to see bigger cuts? Or are we going to see pauses? And that's going to be probably what drives markets. And then you've got increasing turbulence in the Middle East, which could spill over and create quite a lot of volatility.
So, apologies for one more crystal ball type question, but what sectors do you think might perform well over the next year with that in mind?
I think that if you're looking at areas that have been under the cosh from high interest rates, so private equity, infrastructure, renewables, particularly in the investment trust world, I'm obviously an investment trust specialist, so will stay safely in my lane. But I think that for investment trusts, we're looking at areas where we can see increasing corporate activity, which should do well for investors. And we're seeing areas that people might come back to, such as infrastructure and renewables, if gilt yields start to decline. And there's some pretty healthy yields in those areas now. Private equity, I think they're taking away the ongoing charges is very helpful for those kinds of trusts because they had to produce some very, very high OCFs because of how they're invested and what they're invested in. So again, that should be an area that investors hopefully start coming back to as well.
Thank you. And one final question before we wrap things up. Why do you think investors should look at investment trusts above, say, low-cost passive funds?
Well, because investment trusts are closed-ended, it means that they can invest in asset classes that are just not available in open-ended forms. So if you want to invest in illiquid asset classes, then the only way that you can do that is through a trust. We're seeing poorer liquidity in the bottom end of the market in the smaller cap area. So again, I think investment trusts are the perfect way to access that because you have capital and you don't have to deal with inflows and outflows. I think it gives you an opportunity to not just invest in mainstream markets. I think it gives you an opportunity to invest in really interesting areas that works really well as a combination. I think people can have these low-cost ETFs, for exposure to the American market, the global market, maybe the UK market, but they are naturally dominated by large caps because that's the way that they work. And therefore, if you're looking for something that it's not so mainstream, that won't just perform like the index, because the US index has done very well over the past few years, but that doesn't necessarily mean that that's going to continue out, going forwards. Because of what's gone on in the investment trust sector, you've got much bigger discounts. So you can buy £1 worth of assets in a really interesting area for 70p, for example. If you're buying something on a 30 discount, you're buying interesting assets for 70p in the pound, and that is a fantastic opportunity set. So I appreciate that I'm likely to give that answer as an investment trust specialist, but I do think that it's an area that is so rich with opportunity and should be part of people's portfolio.
And on that note, Charlotte, many thanks for joining us today.
Thank you so much.
If you'd like to read more market insights, please head over to the Kepler Trust Intelligence website, where you'll find recent articles on the outlook for gold prices, the pros and cons of investing in your home market, and the most bought and sold investments by UK investors last month, amongst other things. And if you'd like to receive our insight articles on a regular basis, please sign up for our weekly newsletter. We hope you join us again next month for the second episode of Market Matters.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.